Okay, let's unpack this. Have you ever wondered how incredibly large companies, with millions of daily transactions, manage to prove their financial books are squeaky clean without literally checking every single receipt, every invoice, every payroll entry?
Right.
It's like trying to figure out if an entire ocean is clean by testing just a single cup of water. On the surface, that seems impossible, doesn't it?
It really does.
Yet auditors do it every single day. Today, we're taking a truly fascinating deep dive into something called audit sampling.
Hmm.
It's more than just a technique. It's the hidden art and, well, rigorous science behind how auditors make immense, high-stakes decisions based on carefully selected, tiny, but hopefully representative pieces of information.
Exactly. It's fundamentally about trust, risk, and some seriously clever number crunching.
Right, the stuff that underpins the entire system of financial integrity and reliability we all rely on, whether you're an investor, a business owner, or just, curious.
Our mission today is really to equip you with a shortcut, basically, to being well informed on this core aspect of financial assurance.
Okay.
We want you to understand not just what audit sampling is, but why it's absolutely essential, and the ingenious, sometimes counterintuitive methods auditors use, and, critically, the risks involved. By the end of our conversation, you'll hopefully gain those aha moments, seeing precisely what's fascinating here and why this meticulous process truly matters.
Matters for the accuracy and reliability of the financial statements that, well, shape our economy.
Exactly.
And to guide us through this intricate landscape, we've got a fantastic stack of sources today, primarily focused on the foundational principles of sampling, part one in auditing.
Good stuff.
Yeah, it's packed with surprising facts and practical, real-world examples that will hopefully give you clarity and insight into how auditors navigate these complex waters.
Let's dive in.
Yeah.
The fundamental challenge, why don't auditors check everything?
So let's set the stage. Imagine, just for a moment, a massive multinational corporation. We're talking potentially hundreds of subsidiaries operating across different continents, processing millions, maybe tens of millions of financial transactions every single year.
Scale is huge.
Purchase orders flowing in, invoices going out, sales being recorded, payroll for thousands of employees daily. I mean, the sheer volume of this data is staggering.
Mm-hmm.
The idea of an audit firm, even a massive one, trying to check every single one of those transactions, it just seems like an auditor's absolute nightmare.
It would be logistically impossible, financially ruinous for everyone involved, and just incredibly inefficient.
So if checking every single item isn't feasible, but auditors still need to provide assurance that those financial statements are accurate and reliable, what do they actually do? How do they bridge that colossal gap?
That's precisely the fundamental challenge, and it leads to the ingenious methods we're about to discuss. Auditors, in their pursuit of what we call sufficient appropriate audit evidence, have developed three main approaches when it comes to selecting items for testing.
Three main ways. Okay.
Yeah, and each approach has its own very specific application, its own strengths, and, importantly, its own limitations. It's a deliberate choice based on the account, the risks, the practicality. The first approach, which might seem like the ideal, the obvious choice, but is often impractical, is selecting all items.
100% check.
Exactly, 100% examination. As the name suggests, this involves testing every single item in an account balance or every single time a control happens. While it definitely provides the most complete evidence possible, it's surprisingly not the default. Not even common for most large populations because it's just so inefficient.
So when would an auditor actually do this? When would they say, okay, for this specific thing, we're going to look at absolutely everything? Seems extreme.
It really is extreme, and it happens only in very specific justified scenarios. One key situation is when the population itself is pretty small, but the individual items have an exceptionally high dollar value.
Okay, like big ticket items.
Exactly. Think about a company with only a handful of huge multi-million-dollar contracts or maybe a few very valuable pieces of equipment. For these critical items, where just one could significantly impact the financials if it's wrong, 100% check makes sense. It's often necessary. You can't really sample those effectively.
Right, you need to verify each one individually.
Another scenario is when the audit procedure can be fully automated.
Ah, technology helps.
Immensely. If you can write a sophisticated program, say to scan an entire database of millions of entries in seconds maybe to find all transactions over a certain amount or spot weird patterns, then it becomes practical to run it across everything. Automation makes the impractical efficient.
Makes sense.
And finally, a 100% examination is sometimes needed when an audit procedure is designed to respond to what auditors call a significant risk.
Like a high-risk area, fraud, maybe.
Could be fraud, could be very complex transactions. These are risks needing special attention. In such cases, other less intense methods might just not provide enough solid evidence to deal with that higher risk. So the implication is clear. This method gives the most complete evidence. But like we said, it's often just too impractical, too costly, too time-consuming for populations with tons of routine, lower-value transactions.
Okay, so 100% is rare but powerful for specific situations. What's the second approach?
The second distinct approach is selecting specific items. This is more like targeted testing.
Laser focus.
Kind of. The auditor deliberately focuses on items with a particular characteristic. For example, they might test only key items deemed critical for an audit objective. Or very commonly, they test all items over a certain amount, like all transactions over $100,000.
Focusing on the big fish.
Exactly. It's an effective way to concentrate audit effort on material amounts or things that are inherently riskier just because they're bigger.
So if I'm getting this, it's kind of like only tasting the largest cookies in the batch. You grab the biggest ones because they look important, maybe give you a good idea of quality.
That's a great analogy.
You confirm those big cookies are good, but you can't logically assume all the tiny, crumbly cookies are also fine just because the large ones passed the test.
You've articulated the limitation perfectly. That analogy really gets to the core of it. The absolutely crucial limitation with selecting specific items is precisely that. The results from testing those specific items cannot be projected or generalized to the whole population.
Okay, that's key.
You get strong assurance about the specific items you looked at those big cookies, but you gain zero reliable insight about the ones you didn't look at, especially those below your dollar threshold or without that specific characteristic.
So you only know about what you tested.
Exactly. It's focused, it's efficient for what it does, but it doesn't give you that broad picture. It's a scalpel, not a wide-angle lens.
Got it. Which brings us to the third method, the main event.
And that brings us finally to the third and most widely applicable method, the main event for our deep dive today.
Yeah.
Audit sampling. Formally, it's applying an audit procedure to less than 100% of the items in an account balance or class of transactions.
Less than everything.
Right. And the fundamental purpose is powerful. To let the auditor evaluate some characteristic of the overall balance or class, and then draw reasonable conclusions about that entire population based only on the results from that smaller, carefully selected subset.
It's the art of inference, backed by science.
Well put.
And this is where the real statistical ingenuity happens, right? It seems most useful when an auditor doesn't already suspect specific problems. It helps them cast a wide net, find things they wouldn't necessarily target otherwise.
Precisely. Audit sampling shines when the auditor doesn't have prior intelligence pinpointing likely errors. It's designed for a broad, unbiased view. However, this raises that critical question. How can you possibly draw reliable conclusions about a huge universe of data by looking at only a small part?
Yeah, how does that work?
This is where the inherent assumptions, the crucial rules of the game, and the unavoidable risks come in. And it's what makes audit sampling both incredibly powerful and, frankly, complex. It requires both statistical understanding and seasoned professional judgment. 2. The core principles of audit sampling. Rules of the game.
Okay, this is where it gets really interesting.
Yeah.
Because for sampling to work, for those conclusions about the whole based on the part to actually mean something, auditors operate under some very specific, almost golden rules.
Foundational assumptions.
Exactly. These aren't just suggestions. They underpin the whole process, making it mathematically and logically sound. Without these pillars, audit sampling would just crumble.
Couldn't agree more. Let's dive into these.
Let's do it.
The first core principle, the bedrock really, is the assumption of representativeness. When auditors sample, the fundamental assumption is that the chosen sample represents the population it came from.
Meaning what you see in the sample is pretty much what you'd see in the whole group.
Exactly. The characteristics in the sample, whether it's a control error or a dollar mistake, are comparable to and reflective of the characteristics in the entire population.
So like my barrel of apples analogy earlier, if I pick a handful from different spots, I assume they give me a good idea of all the apples in the barrel, ripeness, quality, bruises.
Perfect. If your handful is bruised, you assume the rest might be too. And connecting this to the bigger picture in auditing, this is the cornerstone of reliability. Imagine if your sample was only transactions from January 1st, or only stuff processed by one particular clerk.
Yeah, that wouldn't tell you much about the whole year or the whole team.
Right. Without assuming your sample broadly reflects the whole population, sampling is just a shot in the dark. You can't draw meaningful, statistically valid conclusions. Your snapshot has to be indicative of the whole album.
Okay, assumption of representativeness. Makes sense. But what about when it isn't?
That leads us directly to the unavoidable concept of sampling risk. This is defined as the risk that the chosen sample is, just by chance, not representative of the population.
Bad luck, basically.
Could be. And the consequence is profound. The auditor's conclusion, based only on the sample, will be different from the conclusion they would have reached if they could have checked 100% of everything.
So the sample leads them down the wrong path.
Potentially, yes. It's the built-in uncertainty that comes from inferring about a large group by looking at a small fraction. You can never eliminate it entirely, only manage it.
That's a powerful point, like that polling example. You poll one neighborhood and try to predict a national election. Your sample might look fine, but it's skewed and your prediction is way off, and you don't know until the results are in. That's sampling risk, right? The sample looks okay, but it's misleading.
Precisely. And to intelligently manage this ever-present risk, auditors rely on what are sometimes called the valid estimates pass-key rules.
Okay, the golden rules.
These aren't just guidelines, they're fundamental principles, ensuring the mathematical validity and statistical robustness of their projections from the sample to the population.
Let's hear them.
Okay, Rule 1 dictates that for statistical sampling, you must always assume the population being sampled is normally distributed.
The bell curve.
Right, meaning its values can be described by that familiar bell-shaped curve. Now, this doesn't mean every financial data set is perfectly bell-shaped.
Okay.
Rather, for the statistical math to work rigorously, auditors operate as if it is, or they might transform the data to approximate it.
So why is assuming that bell curve so important? What breaks if you don't?
It's critical because it allows the powerful tools of statistical methods and probability theory to be applied. Without that theoretical underpinning of a normal distribution, the formulas and probabilities used to project sample results just wouldn't hold up.
They'd lack statistical validity.
Exactly. It's the bedrock for using inferential statistics effectively in auditing. It provides the framework for calculating confidence levels and risks. Without it, you're just guessing.
Got it. Rule 1, assume normality for the math. What's rule 2?
Rule 2 states very clearly that for any estimates to have mathematical validity, samples must be unrestricted and randomly selected. This is absolutely critical.
Random selection.
Yes. Every single item in the population must have an absolutely equal chance of being picked. The auditor cannot introduce any bias, intentional, unconscious, or just for convenience. And crucially, if a selected item can't be found or tested for some reason, no substitutes are allowed. You stick with the original selection, or that missing item is treated as an error or deviation.
So no picking the easy ones or the ones you think might have errors to confirm a hunch. It has to be truly blind, like drawing names out of a hat.
You've captured the essence perfectly. Prevents any human inclination from skewing the results. Ensures genuine discovery.
Makes sense. Leads to rule 3.
Leads directly to Rule 3. If the sample is sufficiently large and crucially randomly selected according to Rule 2, then it will likely have the same statistical characteristics, like the mean and standard deviation, as the underlying population.
So that's the payoff for following rule 2. It's how you actually get that representativeness we talked about, not just hope for it.
Exactly. It's a statistical expectation based on proper method.
Okay. And rule 4.
And finally, Rule 4 deals with standard deviation. Standard deviation is a direct measure of variability, the range or spread of values within the population.
How spread out the data is.
Basically, yes. Low standard deviation means data points cluster tightly around the average. High standard deviation means they're much more spread out.
What's interesting here is, well, if there's a lot of variability, a lot of chaos in the data, does that mean you need a bigger sample?
It absolutely does. And that's a crucial point.
Right.
Higher standard deviation means more spread out data, which directly translates to needing a larger sample size to achieve the same level of confidence and precision.
Okay.
Imagine trying to get an average shoe size in a room where half wear size 5 and half wear size 12, high variability. You need a much bigger sample to capture that range accurately compared to a room where everyone's an 8, 9, or 10.
Right. A larger sample ensures you capture the full range in a diverse population. Makes sense. 3, the 2 paths. Statistical versus non-statistical sampling. Okay, so auditors have these foundational rules, but once they grasp the theory, how do they actually do the sampling in practice? When they're out there looking at real data, it turns out there are 2 main paths. statistical sampling and non-statistical sampling.
Right. But before we dive into those two paths, it's absolutely crucial to emphasize something that applies to both. Professional judgment.
Ah, the human element again.
Always. Both statistical and non-statistical approaches absolutely require the pervasive use of professional judgment. It's not math or judgment. It's always math with judgment. Lots of questions try to trick people into thinking statistical sampling eliminates judgment. That's completely false.
Good point.
Judgment is needed at almost every stage, setting parameters, interpreting the numbers, evaluating the overall results and what they mean.
So it's never just letting software run the show. The auditor's still in the driver's seat, making critical decisions, even with the math, setting the guardrails.
Exactly. Professional judgment is indispensable. It's needed for identifying the population, defining the sampling unit, selecting the method itself, evaluating the evidence collected.
Evaluating the nature of errors found too, right? Like, is this a one-off or systemic?
Precisely. Considering sampling risk throughout, evaluating the results, projecting them to the population, judgment ties it all together.
Okay, so judgment is key for both paths. Let's look at the first path, statistical sampling.
Okay. With statistical sampling, auditors start by specifying the exact level of sampling risk they're willing to accept for that test, say a 5% risk of making a certain error. Then, using established statistical formulas and tables, they mathematically calculate the exact sample size needed to provide that specific level of reliability or confidence.
So it's very precise, very calculated.
Yes, and the results from the sample are then evaluated strictly quantitatively. Numbers, probabilities, statistical measures drive the conclusions.
What are the big advantages of going down the statistical road? Seems like a lot of math.
It offers several powerful advantages. First, it lets the auditor objectively measure the sufficiency of the evidence. You can quantify your assurance, say, we are 95% confident.
Okay.
Second, it provides an objective basis for evaluating results, reducing subjectivity or bias. Third, it helps design an efficient sample, aiming for the smallest possible size for the objective, which saves time and money. And maybe most critically, it allows auditors to quantify sampling risk itself, so they can explicitly limit that risk to an acceptable level.
But it requires that random sample selection we talked about.
Absolutely essential for statistical sampling to be valid. Every item needs an equal chance.
Got it. What about the other path, non-statistical sampling?
Or non-statistical sampling, sometimes called judgmental sampling. Here, the sample size is not determined mathematically based on risk levels. Instead, auditors rely heavily on their professional judgment, their experience, understanding of the client, assessment of controls, inherent risk sense to determine the sample size.
More intuition-based, maybe? Or experience-based?
Experience and judgment are key. And similarly, when evaluating the results, they use judgment rather than strict statistical calculations to draw conclusions about the population.
So if both methods exist, and statistical seems to offer quantifiable benefits, are they equally acceptable under auditing standards? Like GAS?
That's a great practical question. And the answer is yes. Both statistical and non-statistical approaches are fully acceptable under GAS if they are properly applied.
So it's about how you do it, not necessarily which method.
Exactly. The crucial element is proper application. Ultimately, the sufficiency and appropriateness of the evidence relate directly to the careful design and adequate size of the sample, regardless of the approach. A well-designed sample, statistically or non-statistically, will generally be more efficient achieving the objective with a smaller size than a poorly designed one, which is always a goal.
Maximum assurance for minimum effort. Makes sense. Brigus. Types of audit sampling and when it might not apply. Okay, so we know how auditors choose sample-specific items, 100% check, or the statistical versus non-statistical paths. Now let's shift focus. What kind of characteristics are they actually trying to estimate or test when they do this sampling?
Right. It's not just about finding errors generally. It's about understanding specific patterns, attributes, or numerical values. Generally, these estimates fall into two broad categories: estimating a rate of occurrence or estimating a numerical quantity or dollar value.
Rate versus amount.
Pretty much. The first type is attribute sampling. This is primarily used for testing controls.
Suggesting if procedures are being followed.
Exactly. The focus is estimating a rate of occurrence specifically, an exception rate or deviation rate of a particular characteristic. For instance, testing a control requiring 2 signatures on checks over $5,000. They want to know the percentage of checks missing that second signature. That absence is the attribute.
So the passkey identifier here is it usually deals with yes or no questions, right? Binary.
That's a great way to put it.
Like, is the invoice approved? Yes, no. Are time cards authorized? Yes, no. It's about whether an attribute is present or absent and how often it's absent.
Precisely. Counting instances of non-compliance or deviations, then projecting that rate. If too many deviations are found, the control is weak.
Okay, that's attribute sampling for controls. What's the second type?
The second main type involves variable sampling and its cousin, probability proportional to size, PPS sampling. These are typically used in substantive testing of account balances.
Testing the dollar amounts.
Exactly. The focus shifts from rates to estimating a numerical quantity, or, most often, dollar values. For example, using variable sampling to estimate the total dollar amount of inventory, or the total value of accounts receivable. Instead of counting errors, they're estimating money.
So attribute sampling asks, is this signature valid? Yes, no. Well, variable sampling asks, is the total receivables amount correct? A dollar value. That distinction really helps.
Perfect analogy. It clarifies their core objectives. Now, while sampling is incredibly powerful, it's important to know there are situations where formal sampling concepts generally do not apply. It's not a one-size-fits-all tool.
Okay. When wouldn't you use sampling?
For instance, risk assessment procedures. The initial work to understand the client's business and internal controls usually don't involve formal sampling.
Just getting the lay of the land.
Right. It's often qualitative, gaining high-level understanding. You're not statistically testing effectiveness yet. Similarly, tests of automated IT controls often don't involve extensive sampling, especially if the general IT controls are strong.
Because computers are consistent.
Exactly. If the underlying IT controls are solid, a control processed by a computer like an automated calculation might only need testing once or a few times to confirm it works. If it works once, it usually works every time, unlike human controls.
Makes sense. What else?
Formal sampling generally doesn't apply to security and access controls or other controls without clear documentary evidence.
Like segregation of duties. Hard to
Right.
sample that.
Precisely. You can't easily sample something if there's no paper trail or system log showing it happened. These are often observed or inquired about instead. And finally, some high-level tests of the overall control environment or accounting system, like examining board or audit committee effectiveness, are usually holistic evaluations.
More qualitative judgment calls.
Right. Assessing the tone at the top, ethical culture, not something you'd apply statistical sampling to. There's no quantifiable population of governance activities.
So why doesn't sampling apply here? It seems like it's because these areas need more qualitative understanding, or the population isn't suitable for statistical projection like, say, 1,000,000 sales orders are.
You've hit the core reason. These areas need deep, qualitative understanding, observation, nuanced judgment. They just don't lend themselves to the numerical estimation and statistical inference that formal sampling is designed for. Sampling works best for large volumes of similar, discrete items. See the elephant in the room. Understanding audit risk and sampling risk.
Okay, let's talk about the big unknown, the inherent uncertainty, the elephant in the room in auditing risk. Specifically, how does the very act of sampling, by not looking at everything, introduce a distinct layer of risk into the whole audit process?
That's the crucial question.
Because even with careful planning and methods, there's always uncertainty when you infer about a whole from a part.
Absolutely. We start with audit risk, the grand umbrella term. It's the overall uncertainty in auditing the risk the auditor gives the wrong opinion when the financials are materially misstated.
The big picture risk.
Right. And it has two fundamental components.
Huh.
First, uncertainties due to sampling, which we've been discussing. Second, uncertainties from factors other than sampling called non-sampling risk, which we'll touch on later.
Okay, focus on sampling risk first.
Right. Sampling risk is that core uncertainty we've been circling. It comes from the possibility that when you test only a sample, your conclusion might be different from the conclusion you'd reach if you tested everything.
So the passkey summary is, sampling risk is the chance the auditor makes a mistake because they only looked at a sample.
Exactly. And there are two main types of mistakes they can make due to sampling risk. One, failing to identify an existing problem. This is dangerous for audit effectiveness. Two, falsely identifying a problem where none exists. This impacts audit efficiency. Understanding these two is fundamental.
Okay, effectiveness versus efficiency. Let's break those down for substantive testing, testing the dollar values.
Okay, first and most critical for effectiveness is the risk of incorrect acceptance. This is the dangerous scenario where the sample suggests the account balance is not materially misstated, but in reality, it is.
The sample misses a big problem.
Exactly. The sample fails to identify an existing material misstatement lurking in the items you didn't check.
That sounds incredibly dangerous. What are the real-world consequences for, say, an investor relying on those financials?
The consequences can be devastating, far beyond just the audit firm's reputation. If this risk happens, the auditor might issue a clean opinion on materially misstated financials. Investors make bad decisions, potentially lose significant money. The company could face fines, lawsuits, loss of confidence, even bankruptcy.
Wow.
That's why auditors accept a very low risk here, maybe 5% or 10%. It directly relates to the audit's effectiveness in protecting the public.
Can you give a concrete example?
Sure. Imagine an auditor confirming accounts receivable. They sample customer accounts, send letters. The responses from the sample all come back okay. So the auditor concludes the total receivable balance is fine and issues a clean opinion. But unbeknownst to them, if they had checked all receivables, they would have found many fictitious ones, meaning the balance was materially misstated.
The sample lied, essentially.
The sample didn't reveal the truth hidden in the rest of the population. That's the risk of incorrect acceptance, a fundamental audit flaw.
Okay, that's the scary one. What's the second risk in substantive testing?
The second is the risk of incorrect rejection. This is the opposite. The sample suggests the balance is materially misstated when actually it is not.
So the sample mistakenly indicates a problem where none exists.
Right. You look at the sample, find some errors, assume the worst, but later find out the problem wasn't as widespread as the sample suggested.
Okay, so let me simplify. Incorrect acceptance risks letting a real problem slip by, harming users. Incorrect rejection risks doing too much work when it wasn't needed. One seems far more serious.
You've hit the nail on the head. Incorrect rejection mainly relates to audit efficiency, not effectiveness. If it happens, the auditor does more work than necessary because they think there's a problem. It wastes time and resources, but it's less critical than incorrect acceptance.
Because they'll eventually find out the truth.
Usually, yes. The extra work will ordinarily lead them to discover the initial assessment was wrong and reach the correct conclusion. So, inefficient, but typically doesn't lead to a flawed opinion.
Okay, that covers substantive testing risks. What about risks in tests of controls, testing the processes?
Similar concepts, but slightly different focus. First risk here is the risk of assessing control risk too low. This happens when the sample shows a lower deviation rate, fewer control errors than actually exists in the population. The auditor concludes the control is effective when it's really not.
A false sense of security from the sample.
Exactly.
And again, this sounds like a serious effectiveness issue, like incorrect acceptance. If you think a control is strong when it's weak, you might not do enough substantive testing later.
Precisely. This risk directly impacts audit effectiveness in detecting material misstatements. It's the more dangerous risk for control testing. It leads the auditor to reduce substantive testing based on that false security, increasing the chance of missing material misstatements.
Can you give an example here too?
Absolutely. Consider testing a control over cash disbursements. Checks over $10,000 need 2 signatures, CEO and Treasury Manager. The auditor samples 10 such checks from a population of 100. All 10 in the sample have both signatures. Great.
Looks
Excellent.
good from the sample.
So the auditor concludes the control is effective, relies on it, plans less substantive testing on cash. But what if the other 90 checks only had 1 signature? The control had actually broken down significantly.
Oh, wow.
The sample showed a 0% deviation rate, but the true rate was 89%. That's assessing control risk too low. The misleading sample led to undue reliance on a weak control. Big potential vulnerability.
Yikes. Okay, what's the second control testing risk?
The second is the risk of assessing control risk too high. Mirror image. The sample indicates a greater deviation rate, more errors than actually exists. The auditor concludes the control's ineffective when it's actually okay.
They think the control is weaker than it is.
Right.
And this one, like incorrect rejection, sounds like it's mainly about efficiency, doing more work than needed.
You've got it perfectly. This squarely relates to audit efficiency. If this happens, the auditor does more substantive testing than necessary because they mistakenly think they can't rely on a control that's actually working fine.
Wastes time and money, but doesn't compromise the final opinion.
Correct. The auditor compensates by doing more direct testing of the figures.
Okay, so these risks are tied to effectiveness or efficiency. How does confidence level fit in?
Confidence level, or reliability, is directly related to those effectiveness risks. Incorrect acceptance and assessing control risk too low. It's probabilistic. If an auditor accepts, say, a 5% risk of being ineffective, it simultaneously means they are 95% confident that their sample is representative and their conclusion is correct.
It's the flip side of the risk.
Exactly. Risk plus confidence equals 100%. It's how auditors quantify their level of certainty based on the risk they're willing to take.
What's fascinating here is how precisely these risks are quantified and managed. It's not just a gut feeling, it's a calculated decision about how much uncertainty the auditor can live with. Really adds rigor.
It does. To summarize visually, think of simple charts. For substantive tests, dollars. Sample says, okay, population is okay. Correct decision. Sample says, okay, population is not okay. Incorrect decision. That's risk of incorrect acceptance, not effective.
The bad one.
The really bad one. Sample says not okay. Population is okay. Incorrect decision. Risk of incorrect rejection, not efficient. Sample says not okay. Population is not okay. Correct decision.
Okay. And for tests of controls processes.
Very similar logic. Sample says okay. Control is okay. Correct. Sample says okay. Control is not okay. Incorrect. Risk of assessing control. Risk too low. Not effective.
Also really bad.
Right. Sample says not okay. Control is okay. Incorrect. Risk of assessing control. Risk too high. Not efficient. Sample says not okay. Control is not okay. Correct.
Those summaries make the trade-offs really clear. 6. Non-sampling risk. The unquantifiable uncertainties. So we've thoroughly explored risks because of sampling, but what about all the other things that can go wrong? Things totally unrelated to whether the sample was representative.
Great point. That brings us to non-sampling risk. This is basically all aspects of audit risk that are not due to sampling. It's everything else that could lead to a wrong opinion.
Stuff beyond the statistics.
Exactly. Unlike sampling risk, non-sampling risk is always present, whether you sample or not. And critically, it cannot be measured quantitatively. You can't put a percentage on human error or bad judgment.
So if you can't measure it, how do auditors deal with it? Seems tricky.
It is a challenge. Since you can't eliminate it, auditors try to reduce it to a very low level through robust practices. Primarily, this involves adequate planning and supervision of the whole audit, ensuring it's well thought out, properly scoped, team members guided and monitored.
Good project management, essentially.
And also maintaining strong quality control over all firm practices. Rigorous training, consistent methods, quality reviews. It's about building a culture of diligence.
Okay. What are some concrete examples of non-sampling risk?
Well, one is selecting audit procedures that are just not appropriate for the objective, like using a revenue test for inventory valuation. The procedure itself is flawed for the task. Another common one is the auditor simply failing to recognize misstatements in documents they actually look at.
Human error.
Purely. Oversight, fatigue, lack of experience.
Wow.
They look right at an error, but don't see it. Completely separate from the sample being representative.
This really reminds us that even with perfect sampling, human judgment, diligent execution, and the audit design itself are paramount. It's a crucial, unquantifiable layer of risk managed through diligence and quality control. Auditing is as much art as science.
Well said.
Oh.
Deep dive into attribute sampling, the step-by-step process.
Okay, now that we've covered the theory, types, and risks, let's get into the real nitty-gritty of one specific type, attribute sampling.
The practical application.
Right. This is what auditors use extensively to check if internal controls are actually working, and there's a clear, methodical 8-step process for it, like a recipe.
Pretty much. The main purpose, remember, is to estimate the rate or percentage of occurrence, the exception or deviation rate of a specific characteristic or attribute. It provides a statistical basis to conclude if controls are being applied as prescribed. Usually those yes or no questions. Are invoices properly voided? Is there a signed agreement? It's about compliance.
Okay, so what goes into planning this?
Significant professional judgment is needed upfront. First, relating the sample to the specific control objective, what exactly are we testing? Then, critically, defining the tolerable deviation rate.
That term again, remind us it's how many mistakes are okay?
Essentially, yes. It's the maximum rate of deviation from a control the auditor will tolerate without changing their planned reliance on it. What's fascinating is deviations don't always mean direct financial misstatements, but they definitely increase the risk of them. So auditors set this threshold for acceptable risk. If the actual rate exceeds this tolerance, the control isn't reliable enough.
Okay. What else is considered in planning?
The auditor's allowable risk of assessing control risk too low, that effectiveness risk we discussed. This affects the confidence level needed. And finally, understanding the population characteristics, specifically the expected deviation rate. What do they think they'll find based on prior experience? This expectation heavily influences the sample size.
Got it. Now, you mentioned a distinction between the sample deviation rate and something else, the worst case scenario.
Right. The sample deviation rate is just the auditor's best estimate based on the sample findings, deviations found, divided by sample size. Simple math. However, and this is a crucial passkey insight, that's just an estimate. Auditors, being conservative, never assume the population exactly matches the sample. They account for sampling risk. So they use statistical formulas or tables to determine the upper deviation rate. This is the maximum deviation rate that could plausibly exist in the population at their desired confidence level. It is the worst-case scenario estimate.
So if they find two errors in 102%, they don't just say it's 2%. They calculate this upper rate, which will be higher, to account for the chance the sample was lucky.
Precisely. It builds in that safety margin for uncertainty. For example, if your sample has 2 deviations in 60 items, 3.33%, and your tolerable rate is 5%, you might think you're good. But the auditor must consider the risk the true rate actually exceeds 5%. That's where the upper deviation rate comes in. Professional judgment is key here. If that upper rate exceeds tolerance, the auditor can't rely on the control as planned. They then have to reevaluate substantive tests, usually meaning doing more dollar value testing. It's a direct consequence.
Okay, let's walk through the 8 steps with an example.
Sounds good. Step 1. Define the objective of the test. Foundational. Clearly state what you're trying to prove or estimate. Example. Determine the percentage of sales orders processed during the year missing the required credit approval signature. Clear, measurable, control-related objective.
The what we're trying to find out question dictates everything else.
Exactly. Step 2. Identify the population. Must be appropriate for the objective, period clearly defined. Example. All sales orders used during the entire fiscal year. Crucial point. If testing is done mid-year, auditors need additional procedures for the remaining period. The population needs to be complete for the period covered.
And if the objective is about all sales, you need to look at all sales orders, not just a convenient subset. Completeness is key.
Precisely. Step 3. Define the sampling unit, the individual item being examined. Example. Each individual sales order. For completeness, using a pre-numbered register or system log is often better than a physical file because items can disappear from a file but not a register. Helps ensure you account for everything.
So picking the actual thing you'll examine and doing it in a way that ensures you're not missing items. Sound process integrity.
Absolutely. Step 4. Define the attributes of interest. Deviations. Meticulously define what counts as an error or deviation where the control wasn't applied properly. Example. A missing credit approval signature, another common one. A selected sales order that cannot be located. That's usually treated as a deviation too because the documentation control failed.
Precision matters here. Clearly define wrong so results are consistent and objective.
Vital for objective evaluation. Step 5. Determine the sample size. Now the numbers really come in. This is a crucial decision, a balancing act based on several factors.
So how many do they actually need to look at? How's that figured out?
Systematically, especially in statistical sampling. First factor, risk of assessing control, risk too low. Inverse relationship. Higher willingness to accept risk, smaller sample. 1. High effectiveness, bigger sample.
Okay.
Second, tolerable deviation rate. Also inverse. Higher acceptable deviation rate, smaller sample. Very low tolerance for deviations, larger sample.
Makes sense.
Third, expected deviation rate. Direct relationship. Expect more deviations. Need a larger sample to accurately estimate that higher rate. Expect few deviations. Smaller sample might suffice.
Okay, expected rate matters. What else?
Finally, population size. Interestingly, once the population is large, say over 5,000 items, its size has very little effect on the sample size needed for attribute sampling.
Really? So going from 10,000 items to 1 million doesn't drastically change the sample size?
Not significantly for attribute sampling, because once a sample is representative, adding more items to the large population doesn't change the sample's statistical properties much.
Let's do example 1, calculating sample size.
Okay. Auditor tests sales orders for credit approval. They accept 5% risk of assessing control risk too low. They expect a 1% deviation rate based on last year. Tolerable deviation rate is 6%. Using a theoretical sample size table, finding the intersection of these parameters, the required sample size would be about 78 sales orders.
Okay, 78. How does that change?
If expected deviation rate dropped to 0%, sample size decreases. Less expected error, less evidence needed. If tolerable rate increased to 7%, more errors acceptable, sample size decreases. Higher leniency needs less certainty. If risk of assessing control risk too low increased to 10%, willing to take more risk, sample size decreases. Less certainty needed for a higher risk appetite.
Great illustration. Small changes in assumptions mean big differences in workload. It's all about balancing risk and effort.
Precisely. It's an optimization. Step 6. Select the sample. Once size is set, pick the items. Most common is random selection. Every item has an equal chance. Best adheres to our rule. Systematic selection is also okay. Pick every nth item, like every 10th sales order, after a random start. Downside. Results skewed if errors occur systematically, like every 10th item is bad.
Potential bias there.
Could be. What's generally not acceptable for statistical conclusions is block or cluster sampling. Selecting groups, like all sales orders from one day, highly unlikely to be representative.
So that passkey rule 2 about random, unbiased selection is really practical here. Guards against biases in validating the whole thing.
It's the linchpin. Step 7. Evaluate the sample results. After testing, evaluate the findings. First, calculate the sample deviation rate. Deviations found divided by sample size. Simple. 3 errors in 100 equals 3%. But remember, that's just the estimate. Auditor then projects to find the upper deviation rate, usually using a statistical table corresponding to the risk level. Find the intersection of sample size and number of deviations found. That gives the upper rate.
Which includes that buffer for uncertainty.
Exactly. The formula is basically sample deviation rate plus allowance for sampling risk, upper deviation rate. That allowance is the cushion acknowledging the sample isn't perfect.
Let's do example 2, evaluating results.
Okay. Auditor finds one missing credit approval in a sample of 100 sales orders. One deviation.
Okay, sample rate is 1%. 1,100 seems low.
Correct. Now, using a theoretical table for 5% risk, sample size 100, one deviation, the upper deviation rate is determined to be 4.7%. The allowance for sampling risk here is 3.7%. 4.7% upper rate, 1% sample rate. The conclusion. The auditor is 95% confident the true population deviation rate does not exceed 4.7%.
Fascinating. Found one error, 1%, but you're 95% sure the real rate isn't higher than 4.7%. That extra 3.7% is the allowance for sampling risk in action, making a conservative leap.
Exactly. Being conservative, preparing for the worst case that the sample was luckier than the true population, protects the audit integrity.
Got it. Final step.
Step 8. Form conclusions about the internal control tested, the decision point. The rule is critical. If the calculated upper deviation rate is less than or equal to the auditor's tolerable deviation rate, the auditor may rely on the control, assuming no other contradictory evidence. Sufficient assurance. However, if the upper deviation rate exceeds the tolerable rate, the auditor would not rely on the control as planned. Two options. 1. Test a different compensating control. 2. More commonly, modify substantive tests usually means doing more detailed dollar value testing to compensate for the weak control. Shift strategy.
And the passkey point. Always use the upper deviation rate, worst case for the conclusion, not just the sample rate.
Absolutely correct. Always err on the side of caution. Let's use example 3. Forming conclusions. Upper deviation rate was 4.7%. If tolerable rate was 3%, would the auditor rely? No. 4.7%, 3%. Upper bound exceeds tolerance. If tolerable rate was 6%, would they rely? Yes. 4.7%, 6%. Potential worst case is within acceptable limits.
Crystal clear how that worst case number drives the decision. It's all about managing risk for sufficient assurance. The numbers dictate the strategy.
And finally, documentation. Non-negotiable. Auditors must document every step. Planning, rationale, parameters, procedures, results, evaluation, interpretation. Crucial for audit quality and review. The audit trail, other attribute sampling models, briefly.
Okay, we've covered the main attribute sampling process deeply, but you mentioned there are a couple of specialized models for specific situations.
That's right. Not as broadly used, but tailored solutions exist. First is discovery sampling. This is used when the auditor believes the population deviation rate is 0 or near 0, and they're specifically looking for a very critical characteristic, like fraud or a major control breakdown. Goal isn't estimating a rate, but finding at least one if it exists.
High-stakes search.
Exactly. Auditor predetermines high confidence, say 95% or 99%, at a very low tolerable rate, maybe 0.1%. Uses tables to find a sample size, giving that confidence of detecting at least one instance if it exists at or above that low rate.
So if they find nothing, they're very confident the critical error rate is incredibly low. But if they find even one,
it raises a massive red flag. Signals a much deeper problem needing investigation. It's like a tripwire for rare but high-impact events.
Powerful tool for critical checks. What's the other specialized model?
Stop-or-go sampling, also called sequential sampling. Its main purpose is to avoid oversampling for attributes, used when few errors are expected.
Efficiency-focused.
Right. It allows the auditor to stop testing before completing all planned steps if early results are overwhelmingly clear. For instance, if after a small initial sample, no deviations are found, and the stats already show the likelihood of a material deviation rate is acceptably low, they can stop further testing.
Lets the evidence guide the effort dynamically. Saves time if things look good early on.
Precisely. Maximizes efficiency without compromising effectiveness. Outro.
Wow, what an incredibly comprehensive deep dive into audit sampling. We've really unpacked
It
everything.
covered a lot of ground.
Yeah, from why auditors can't check everything to those critical passkey rules for representativeness. We navigated statistical versus non-statistical paths, dissected sampling risk incorrect acceptance, assessing control risk too low.
The effectiveness versus efficiency risks.
Right. And walked through the detailed 8 steps of attribute sampling, even how those tables quantify uncertainty.
What's truly fascinating, I hope listeners grasp this, is that audit sampling, while rooted in math, is fundamentally an exercise in professional judgment and risk management.
Absolutely.
It's about drawing reliable conclusions from limited data, constantly balancing efficiency with effectiveness, and always considering that worst-case scenario for true assurance.
So the next time you hear about a company's clean audit opinion, remember the intricate dance of statistics and judgment behind it. It makes you wonder, doesn't it, about the hidden power of a carefully selected few items speaking for maybe millions of others. What implications does this delicate balance of risk and confidence have for other areas where we rely on limited info for big decisions? Medical trials, market research, even our own daily choices about what to trust.
It's a fundamental concept with broad relevance.
Keep exploring, keep asking those insightful questions, and we'll be here to take another deep dive with you very soon.